Chapter 15, Capital Budgeting Decisions. The term capital budgeting is used to describe how managers plan significant cash outflows on projects that have long-term implications, such as the purchase of new equipment and the introduction of new products. So in this lecture, we're going to describe the several tools that can be used by managers to help make these types of investment decisions. Capital budgeting analysis can be used for any decision that involves an outlay now in order to obtain some future return. Typical capital budgeting decisions include cost reduction decisions. Should new equipment be purchased to reduce costs? Expansion decisions. Should a new plant or warehouse be purchased to increase capacity and sales? Equipment selection decisions. Which of several available machines should be purchased? Lease or buy decisions. Should new equipment be leased or purchased? Equipment replacement decisions. Should old equipment be replaced now or later? There are two main types of capital budgeting decisions. Screening decisions relate to whether a proposed project passes a preset hurdle. For example, a company may have a policy of accepting projects only if they promise a return of 20% on the investment. And preference decisions relate to selecting among several competing courses of action. For example, a company may be considering several different machines to replace an existing machine on the assembly line. So here we're going to discuss ways of making screening decisions. Preference decisions are discussed toward the end of the chapter. The time value of money concept recognizes that $1 today is worth more than $1 a year from now. Therefore, projects that promise earlier returns are preferable to those that promise later returns. The capital budgeting techniques that best recognize the time value of money are those that involve discounted cash flows, and that is the concept of discounting cash flows and using present value, which we'll talk about later. So learning objective number 1 is to evaluate the acceptability of an investment project using the net present value method. The net present value method compares the present value of a project's cash inflows with the present value of its cash outflows. The difference between two streams of cash flows is called the net present value. The net present value is interpreted as follows. If the net present value is positive, then the project is acceptable. If the net present value is 0, then the project is acceptable. If the net present value is negative, then the project is not acceptable. Net present value analysis, as well as the internal rate of return, emphasizes cash flows and not accounting net income. The reason is that accounting net income is based on accruals that ignore the timing of cash flows into and out of an organization. Examples of typical cash outflows that are included in net present value calculations are shown on this slide. Notice the term working capital, which is defined as current assets less current liabilities. The initial investment in working capital is a cash outflow at the beginning of the project for items such as inventories. It is recaptured at the end of the project when working capital is no longer required. Thus, working capital is recognized as a cash outflow at the beginning of the project and a cash inflow at the end of the project. Typical cash inflows are shown here in net present value calculations. The net present value method excludes depreciation for two reasons. First, depreciation is not a current cash outflow. Second, discounted cash flow methods automatically provide for a return of original investment, thereby making a deduction for depreciation unnecessary. Assume the facts that we see here at Carver Hospital. Will we be allowed to invest in the attachment? The net present value of the investment we see is 0. This implies that the cash inflows are sufficient to recover the $3,170 initial investment. Therefore, depreciation is unnecessary and to provide exactly a 10% return on investment. Two simplifying assumptions are usually made in net present value analysis. The first assumption is that all cash flows other than the initial investment occur at the end of periods. The second assumption is that all cash flows generated by an investment project are immediately reinvested at a rate of return equal to the discount rate. A company's cost of capital, which is defined as the average rate of return a company must pay to its long-term creditors and shareholders for the use of their funds, is usually regarded as the minimum required rate of return. The cost of capital is used as the discount rate that serves as a screening device in net present value analysis. So assume the information as we see here for a company called Lester Company. Also assume at the end of 5 years the working capital will be released and may be used elsewhere. Lester Company's discount rate is 10%. So should the contract be accepted? The annual net cash inflow from operations of $80,000 is computed as shown. Since the investments in equipment and working capital occur immediately, the discounting factor is 1. Present value factor for an annuity of $1 for 5 years at 10% is 3.791. Therefore, the present value of the annual net cash inflows is $303,280. The present value factor of $1 for 3 years at 10% is 0.751. Therefore, the present value of the cost of relining the equipment in 3 years is $22,530. Present value factor of $1 for 5 years at 10% is 0.61. Therefore, the present value of the salvage value of the equipment is $3,105. The net present value of the investment opportunity is $85,955. Since the net present value is positive, it suggests making the investment. Using the spreadsheet provides an NPV of $85,920. In the spreadsheet format, cash flows are laid down year by year so that the user can have a summarized cash flow in each year throughout the project. Present value are then calculated on the year-by-year basis using the discounting factors. If a computerized spreadsheet such as Excel, is used, it can shorten the computation by using the MPV function. So let's do a quick check. Denny Associates has been offered a 4-year contract to supply computing requirements for the local bank. What is the net present value of the contract with the local bank? Here's how we will calculate it. $28,230. That's how we do it. Let's go on to learning objective number 2. Evaluate the acceptability of an investment project using the internal rate of return method. The internal rate of return is the rate promised by an investment project over its useful life. It is sometimes referred to as the yield on a project. The internal rate of return is the discount rate that will result in a net present value of 0. The internal rate of return works very well if a project's cash flows are identical every year. If the cash flows are not identical every year, a trial and error process can be used to find the internal rate of return. The internal rate of return is equal to or greater than the minimum required rate of return. Then the project is acceptable. If it's less than the required rate of return, then the project is rejected. Using internal rate of return, the cost of capital acts as a hurdle rate that a project must clear for acceptance. So here we have a company, the Decker Company. It can purchase a new machine at a cost of $104,000 that will save $20,000 per year in cash operating costs. The machine has a 10-year life. Since the cash flows are the same every year, the equation shown can be used to compute the appropriate present value factor of 5.216. Using the present value of an annuity of $1 table, the internal rate of return is equal to 14%. If Decker's minimum required rate of return is equal to or greater than 14%, the machine should be purchased. Assume the facts given for this project. What is the internal rate of return on the project? 12%. Take a minute and review the solution to the problem. $79,310 divided by $22,000 equals 3.605, which is the present value factor for an annuity over 5 years when the interest rate is 12%. The net present value method offers 2 important advantages over the internal rate of return method. The net present value method is often simpler to use. The internal rate of return method makes a questionable assumption that cash inflows can be reinvested at the internal rate of return. If the internal rate of return is high, this assumption may be unrealistic. It's more realistic to assume that the cash flows can be reinvested at the discount rate, which is the underlying assumption of the net present value method. We'll now expand the net present value method to include 2 alternatives in the concept of relevant costs. The net present value method can be used to compare competing investment projects in 2 ways: the total cost approach and the incremental cost approach. Assume that White Company has 2 alternatives: remodel an old car wash or remove the old car wash and replace it with a new one. The company uses a discount rate of 10%. The annual net cash inflows are $60,000 for the new car wash and $45,000 for the old car wash. In addition, assume that the information as shown relates to the installation of the new washer. The net present value of installing a new washer is $83,202. Using the spreadsheet provides an MPV of $83,149. If White chooses to remodel the existing washer, remodeling costs would be $175,000 and the cost to replace the brushes at the end of 6 years would be $80,000. The net present value of remodeling the old washer is $56,405. Using the spreadsheet provides an MPV, net present value, of $56,348. While both projects yield a positive net present value, the net present value of the new washer alternative is $26,797, higher than the remodeling alternative. Under the incremental cost approach, only those cash flows that differ between the remodeling and replacing alternatives are considered. The differential cash flows between the alternatives are as shown. Notice the net present value of $26,797 is identical to the answer derived from the total cost approach. Using the spreadsheet provides an NPV of $26,802. Consider the information provided for two alternative projects. The company uses a discount rate of 14% to evaluate projects. Which of the following statements is true? The net present value of project B is greater than the net present value of project A by $5,230. And there's your solution. In decisions where revenues are not directly involved, managers should choose the alternative that has the least total cost from a present value perspective. Home Furniture Company is an example here and is trying to decide whether to overhaul an old delivery truck or purchase a new one. The company uses a discount rate of 10%. Information pertaining to the old and new trucks is shown here. The net present value of buying a new truck is $32,883. The net present value of overhauling the old truck is $42,255. Notice that both MPV numbers are negative because there's no revenue involved. This is a least cost decision. Using the spreadsheet provides a negative NPV of $32,882 for the option of buying the new truck and a negative net present value of $43,253 for the option of keeping the old truck. So the net present value in favor of purchasing the new truck is $9,372. So let's do a quick check. Bay Architects is considering a drafting machine that would cost $100,000, last 4 years, provide annual cash savings of $10,000, and considerable intangible benefits each year. How large in cash terms but the intangible benefits have to be per year to justify investing in the machine if the discount rate is 14%. There's the solution. Learning objective number 3, let's evaluate an investment project that has uncertain cash flows. Assume that all of the cash flows related to an investment in a supertanker have been estimated, except for its salvage value in 20 years. Using a discount rate of 12%, management has determined that the net present value of all the cash flows except the salvage value is a negative $1.1 million. This negative present value, negative net present value will be offset by the salvage value of the supertanker. How large would the salvage value need to be to make this investment attractive? The equation here is used to determine that if the salvage value of the supertanker is at least $10 million, the net present value of the investment would be positive and therefore acceptable. While the salvage value is not known with certainty, the $10 million figure offers a useful reference point for making a decision. So in this lecture, we've assumed that an investment cannot be postponed and that once started, nothing can be done to alter the course of the project. The ability to delay the start of a project, to expand it if conditions are favorable, and to cut losses if they are unfavorable adds value to many investments. The value of these real options can be quantified using what is called real options analysis, which is beyond the scope of this lecture. So let's do learning objective number 4. And that is to rank investment projects in order of preference. So recall that when considering investment opportunities, managers must make 2 types of decisions: screening decisions and preference decisions. Screening decisions, which come first, pertain to whether or not some proposed investment is acceptable. Preference decisions, which come after screening decisions, attempt to rank acceptable alternatives from the most to least appealing. Preference decisions need to be made because the number of acceptable investment alternatives usually exceeds the amount of available funds. When using the internal rate of return method to rank competing investment projects, the preference rule is the higher the internal rate of return, the more desirable the project. The net present value of one project cannot be directly compared to the net present value of another project unless the investments are equal. In the case of unequal investments, a profitability index can be computed as the net present value of the project divided by the investment required. So note 3 things. The profitability indexes for investments A and B are 0.1 and 0.2 respectively. The higher the profitability index, the more desirable the project. Therefore, the investment B is more desirable than investment A. As in this type of situation, the constrained resource is the limited funds available for investment. The profitability index is similar to the contribution margin per unit of the constrained resource. This section focuses on 2 other methods for making capital budgeting decisions: the payback method and the simple rate of return. The payback method will be discussed first, followed by the simple rate of return. So let's talk about the payback method, learning objective number 5. payback method focuses on the payback period, which is the length of time that it takes for a project to recoup its initial cost out of the cash receipts that it generates. When an annual cash inflow is the same every year, the formula for computing the payback period is the investment required divided by the annual net cash inflow. Assume the management of Daily Grind wants to install an espresso bar in its restaurant. The cost of the espresso bar is $140,000 it has its 10-year life. The bar will generate annual cash inflows of $35,000. Management requires a payback period of 5 years or less. So what is the payback period on the espresso bar? Payback period is 4 years. Therefore, management will choose to invest in the bar. So consider the information provided for two investments. Which project has the shortest payback period? Project X has the shortest payback period of 2 years, but the real question is, which project do you think is better? It looks like Project Y may be better of the two investments because it has a much higher cash inflow over the 10-year period. Criticisms of the payback method include the following. First, a shorter payback period does not always mean that one investment is more desirable than another. This is because the payback period ignores cash flows after the payback period. Thus, it has no inherent mechanism for highlighting differences in useful life between investments. Second, the payback method does not consider the time value of money. Strengths of the payback method include the following. It can serve as a screening tool to help identify which investment proposals are in the ballpark. It can aid companies that are cash poor in identifying investments that will recoup cash investments quickly. It can help companies that compete in industries where products become obsolete rapidly to identify products that will recoup their initial investment quickly. When the cash flows associated with an investment project change from year to year, the payback formula introduced earlier cannot be used. Instead, the unrecovered investment must be tracked year by year. For example, if a project requires an initial investment of $4,000 and provides uneven net cash inflows in years 1 to 5, you see here, this investment would be fully recovered in year 4. So compute the simple rate of return for an investment as our learning objective. The simple rate of return method, which is also known as the accounting rate of return or unadjusted rate of return, does not focus on cash flows. Rather, it focuses on accounting net operating income. The equation for computing the simple rate of return is shown here. Assume the management of Daily Grind wants to install an espresso bar in its restaurant. The cost of the espresso bar is $140,000 and has a 10-year life. The espresso bar will generate incremental revenues of $100,000 and incremental expenses of $65,000, including depreciation. So what is the simple rate of return on this project? It's 25%. Criticisms of this simple rate of return include the following. First, it does not consider the time value of money. The second, the simple rate of return fluctuates from year to year when used to evaluate projects that do not have constant annual incremental revenues and expenses. The same project may appear desirable in some years and undesirable in others. A post-audit is a follow-up after the project has been completed to see whether or not expected results were actually realized. The data used in a post-audit analysis should be actual observed data rather than estimated data. So let's discuss the concept of present value, or in objective number 7. We'll understand present value concepts and the use of present value tables. A dollar received today is worth more than a dollar received a year from now because you can put it in the bank today and have more than a dollar a year from now. Assume the bank pays 8% interest on a $100 deposit made today. How much will the $100 be worth in 1 year? The equation needed is shown here. F is the balance at the end of the period, P is the amount invested now, R is the rate of interest per period, N is the number of periods. So to solve this equation, the answer is 108. The $100 outlay is called the present value of $108 amount to be received in 1 year. It's also known as the discounted value of the future $108 receipt. What if the $108 was left in the bank for a second year? How much would the original $100 be worth at the end of the second year? The equation needed to answer this question is shown here. F is the balance at the end of the periods. P is the amount invested now. R is the rate of interest per period. And N is the number of periods. So we solve this equation, the answer is 116.64. The interest that is paid in the second year on the interest earned in the first year is known as compound interest. An investment can be viewed in 2 ways. Its future value or its present value. In the example just completed, the present value was known and the future value was the unknown that we have computed. Let's look at the opposite situation. The future value is known and the present value is unknown that we must compute. Assume a bond will pay $100 in 2 years. If investors can earn 12% on their investments, what is the present value of the bond? The equation needed to answer this question is shown here. Solving the equation, P is $79.72. This process is called discounting. We have discounted the $100 to its present value of $79.72. The interest rate used to find the present value is called the discount rate. So we can verify, and that's shown here, that if we put $79.72 in the bank today at 12% interest, it would grow to $100 at the end of 2 years. We can also use the present value of $1 table from Appendix B1 to verify the accuracy of the $79.72 figure. An excerpt of the appropriate table is shown here. So the appropriate present value factor is 0.797, and the present value is $79.72. How much would you have to put in the bank today to have $100 at the end of 5 years if the interest rate is 10%? Answer is $62. Although some investments involve a single sum to be received or paid at a single point in the future, other investments involve a series of identical cash flows known as an annuity. So here we have Lacey Corporation, let's assume they purchased a tract of land on which a $60,000 payment will be due each of the next 5 years. What is the present value of the stream of cash payments when the discount rate is 12%? So, this is an excerpt from the table we use for present value of annuity. And the appropriate present value factor is 3.605. So the present value is $216,300. The interest rate is 14%. How much would you have to put in the bank today so as to be able to withdraw $100 at the end of each of the next 5 years? $343 is the solution. So let's talk about income taxes and capital budgeting decisions. So learning objective number 8 is to include income taxes in the analysis. So let's identify some simplifying assumptions. Taxable income equals net income as computed for financial reports. The tax rate is a flat percentage of taxable income. Expenditure net of its tax effect is known as after-tax cost. The equation for determining the after-tax cost of any tax-deductible cash expense is as shown. Assume a company with a 30% tax rate is contemplating investing in a training program that will cost $60,000 per year. The aforementioned equation can be used to determine the after-tax cost of the training program is $42,000. The amount of net cash inflow realized from a taxable cash receipt after income tax effects is considered and known as the after-tax benefit. The equation for determining the after-tax benefit of any taxable cash receipt is as shown. So while depreciation is not a cash flow, it does affect the taxes that must be paid and therefore has an indirect effect on a company's net cash flows. When depreciation deductions shield revenues from taxation, they are generally referred to as a depreciation tax shield. The equation for calculating the tax savings from a depreciation tax shield is shown here. Remember that when an asset is purchased, a cash outflow occurs. Depreciation is just the allocation of that purchase price over some estimated life. In Asia Pacific, most countries give tax allowance on depreciable assets or pool of depreciable assets in accordance with the rates set by the tax authorities. This allowance is often referred to as capital allowance, and its tax deductible rates are often different from the tax depreciation rates found in a company's financial statements. Therefore, the depreciation tax shield equation based on the corporate tax rate multiplying depreciation deduction in the financial statements may not work in most Asia-Pacific countries. The concept of getting tax benefits from depreciable assets remains the same. Due to the complication of tax laws in different countries, we use the simplified version to help understand the concepts. So assume that a company has annual cash sales and cash operating expenses of $500,000, $310,000, a depreciable asset with no salvage value on which the annual straight-line depreciation expense is $90,000, and a 30% tax rate. The aforementioned equation can be used to calculate the depreciation tax shield of $27,000. The The answer can also be determined by calculating the taxable income and income tax for two alternatives, without the depreciation deduction and with the depreciation deduction. Depreciation tax shield would be the same, $27,000. Holland Company owns the mineral rights to land that has a deposit of ore. The company is deciding whether to purchase equipment and open a mine on the property. The mine would be depleted and closed in 10 years, and the equipment would be sold for its salvage value. Pertinent financial information is shown here. Holland's after-tax cost of capital is 12%, and its tax rate is 30%. Should Holland open a mine on the property? Step 1. The first step is to compute the annual net cash receipts of $80,000 from operating the mine. Step 2 is to identify all relevant cash flows as shown. Notice that Holland uses straight-line depreciation, assuming no salvage value, to compute depreciation deductions for tax purposes. The third step is to translate the relevant cash flows to after-tax cash flows as shown here. The fourth step is to discount all cash flows to their present value as shown. So notice that the net present value of the project is $24,744. The spreadsheet approach provides an NPV, or net present value, of $24,765.